This is Matthew Kratter's Bitcoin University. Today I want to talk about how to generate income from your Bitcoin, and we're going to be talking about MSTY, which a lot of people have asked me to speak about. So Bitcoin is what's called a bearer asset. You can hold it yourself. There's no counterparty risk when you hold it yourself. So let's start by thinking about bearer assets in general. We can think about a bar of gold, which was really the original bearer asset. So how can I generate income from this gold bar? It's actually a pretty difficult problem to solve because bearer assets like physical gold and Bitcoin do not offer yield or give off cash flows, unlike bonds, which offer interest payments, stocks, which can offer dividends, businesses, which can generate free cash flow, and rental properties, which can generate monthly rent. That's one reason that bearer assets are difficult to value, because you can't use discounted cash flow models because there is no cash flow. And again, we're talking about bearer assets, so an ETF like GLD, for example, is more of a stock, and it obviously doesn't offer a dividend either because the underlying gold does not offer a dividend or cash flow. So how do you generate cash flows or yield from a gold bar? Number one, you can scrape off tiny pieces of it and sell them for cash. Gold makes this very difficult in practice because it's not easily divisible. And the other problem with doing this is that you end up with less gold over time unless you're able to replenish it. But the only real way to replenish it is to find it or to have some sort of income stream or cash flows that it can allow you to buy more gold. Number two, you can lend out the gold bar to someone who's willing to pay you for the privilege of borrowing the gold, like a bullion bank or a gold dealer, for example, and then they make monthly or quarterly payments to you in exchange for your letting them hold your gold. The problem with this option is that you give up possession of the gold bar temporarily, and so it's no longer a bearer asset, and then you may be ending up giving it up permanently if they lose the gold bar. They might be borrowing the gold bar because they need physical gold to sell short, in other words, to bet on lower prices. They might be rehypothecating the gold, lending it out to someone else who might lend it out to someone else. And if that reminds you of BlockFi, Celsius, Genesis Trading, and Three Arrows Capital, if you were around for the 2022 Bitcoin and crypto fiasco, you would be right. That was rehypothecation and people playing these games with yield. Number three way of generating income from gold. You put your gold bar in a gold deposit account and you earn yield on it. But this is like number two. It has the same problem. And the big question to always ask here is, where does the yield come from? Are the managers of the gold deposit account just lending it out, duplicating number two above like BlockFi did with your Bitcoin? Number four, here's another way to generate income or cash flows from physical gold. You borrow against your physical gold in exchange for US dollars, and then you make monthly interest payments to the lender. In other words, you have a US dollar loan that's been collateralized or backed by Bitcoin, and then you take those US dollars and you invest in bonds, dividend stocks, cash flowing real estate. You start a lemonade stand or whatever you want to do. Now, if you're paying 10% to borrow US dollars against your physical gold, you can't use the proceeds, or it would not be wise to use the proceeds to buy a US government bond that yields 4.5%. You need rather to invest it in something that generates yields greater than 10% so that you can keep making those 10% annual interest payments while keeping the difference, the spread, for yourself. Something else you could do, you could borrow against your gold to buy a house that you live in or rent out. So these are different ways to generate yield from a bearer asset like gold. We're going to talk about Bitcoin now, but before I do, I just ask you, if you're finding this video interesting so far, please help to support this channel's educational mission. Hit the subscribe button if you haven't already. That really does help. Leave a like, leave a comment, question, suggestion for a future video, and share this video with a friend or a family member. So now let's talk about Bitcoin as a bearer asset. How can you generate yield on your Bitcoin, i.e. use it to create cash flows or an income stream? Number one, just like with the example of physical gold, you could sell off tiny pieces as needed, and this has the advantage of having very good tax treatment if it's been held for at least a year, because you'll be paying long-term capital gains taxes on it, which are usually lower than income taxes, or the marginal rate for your income tax. Number two, you can move your Bitcoin to a place like BlockFi that will pay you interest on it. But then, of course, there's the question, where does the interest come from? Is my Bitcoin being rehypothecated? Because if a corporation's going to be paying you interest on your Bitcoin, they need to be earning the yield from somewhere in order to pay you. Otherwise, it's not a sustainable business. Number three, you can borrow US dollars against your Bitcoin. We've spoken about this on the channel before, and I've done some live workshops on it over at Bitcoin University. You can borrow US dollars against your Bitcoin, use the US dollars to buy a bond, to buy stocks, to buy a rental property, a private company, a lemonade stand, or start a new business that will pay you cash flows. Number 2 and number 3 come with rehypothecation risk, counterparty risk, because what happens if they don't give you back your Bitcoin at the end of the loan because it got confiscated by the US government or some other agency, or they accidentally lost it, or they loaned it out, they lent it out to someone who then lent it out to someone else who lost it, and so you have this whole chain of rehypothecation and you end up not getting your Bitcoin back. And meanwhile, Bitcoin will probably have gone up a lot. This is what happened to people with Celsius and BlockFi. Number 4, you can set up a corporation, take it public, have it issue common and preferred shares of stock, have it issue debt, regular plain vanilla debt, convertible debt, all these different strategies for capital raising, and do this in order to raise money that you can use to buy Bitcoin. Then allow Wall Street to issue options on your common stock and allow fund managers to trade those options. We're obviously talking about MSTY here, the Yield Max MSTR Option Income Strategy ETF. This ETF has become very popular on Twitter, and now we have some nice memes on it, some nice cartoons, presumably being made by AI. I'm a Bitcoin maxi, no 401k, no stocks, just Bitcoin, and then a bunch of Bitcoin maxis saying, you can't buy MSTY, and the person responding, but MSTY gives me income, so I never sell my Bitcoin. And then the conclusion here, which I'm not sure I agree with, people stacking MSTY are more maxi than the maxis. This is obviously trying to be provocative, like many things on X. Yeah, that's great, but how do you get yourself some MSTY in the first place? You have to buy it in your brokerage account using US dollars, or you can convert your euros or yen or Canadian dollars or pounds to US dollars and then use that to buy MSTY. You could also convert your stocks and bonds to US dollars and use the proceeds to buy MSTY. You could also sell your Bitcoin for US dollars and use those US dollars to buy MSTY. The thing is, capital is fungible. And the real reason you didn't have to sell your Bitcoin to buy MSTY, as it says in the cartoon, in the first place, is because you had some cash, you had some US dollars that you used to buy MSTY, rather than first exchanging your Bitcoin for US dollars and then those US dollars for MSTY. So I think it's a little bit disingenuous to be pretending that you didn't have to sell any BTC to buy MSTY. This is technically true, but you could have bought BTC with that same capital instead of MSTY. Again, capital is fungible. And you're quite welcome to take your capital, to take your savings and put it in BTC, put it in Bitcoin itself. You can hold it in cold storage. You can ask someone else to hold it for you, which is more risky. You can also take your capital and instead of putting it in BTC, you can put it in a more leveraged vehicle like a strategy, MSTR, or you can put it in MSTY. You can put it in a rental property or a dividend stock or a bond or whatever you want to, because it is your money after all. But I just think it's a misuse of language to call it investment in an actively managed Wall Street fund that writes calls on MSTR, which is itself a corporate vehicle that buys BTC and stores it at regulated U.S. custodians. I think it's just a misuse of language to call this a Bitcoin maximalist investment. Again, this isn't about virtue signaling or telling people what the label means. You can use words in whatever way you want. And you're also welcome to own second or third order derivatives of Bitcoin if you want to. I just want to make sure here that people aren't fooling themselves. And I see a lot of people fooling themselves on Twitter and on YouTube. I think personally that MSTY is a very risky investment. It's not a magic money machine, and it comes with loads of execution risk. And if you spent decades in this business, as I have, you will have come to the conclusion, probably sooner rather than later, that Wall Street sucks, that most hedge fund managers underperform basic stock indices, and they certainly underperform holding Bitcoin, holding BTC. And you're also really lucky if you invest in a fund or a hedge fund that returns 20% a year for 10 years and doesn't blow up along the way. This is very, very difficult to do. There's also nothing special about covered calls, synthetic covered calls, call spreads, selling cash secured puts, which are really the same thing as covered calls. These are well-known strategies that I've personally used for decades, but not anymore, not since I discovered Bitcoin. And in these strategies, they are structured such that you give up the upside of a security in exchange for collecting a premium. And there's nothing wrong with that. This is how options work. It's also, the thing is though, it's not covered calls, and these related strategies are not a license to print 60% returns or 100% returns or whatever you want. even if the underlying stock is really volatile like MSTR, which of course the volatility helps to pump option premiums, because when you have high realized volatility or high expected volatility, that increases options prices. This is just basic Black-Scholes. Now, there are many layers of risk and many things that could and probably will go wrong with this product, with MSTY. Now, I get it. People have lives and families. They need income to support themselves while they're waiting for Bitcoin to moon. But Bitcoin in cold storage, this is the problem. Again, it's a bare asset. It won't pay the rent or it won't buy groceries. And in addition, hodling Bitcoin can be very, very stressful. Borrowing against your Bitcoin can also be very stressful, because if Bitcoin's fiat price drops and you get a margin call, you have to put up more capital. And people do need income. They need income to survive and take care of their families. People need income and people want income. But just because you want or need something doesn't mean that the universe is obliged to provide you with it, and especially to provide you with it from some Wall Street product. All of Wall Street products are basically garbage over time. I'll tell you how I generate income from my Bitcoin. I hodl my BTC in deep cold storage using multisig, and then I make YouTube videos about BTC, and I sell courses on Bitcoin, which is great because I get paid to spend my time thinking about BTC and talking to all of you, talking to smart people, and learning new things every day. So I consider myself very lucky. I don't know how I stumbled into this. It's very strange, especially since I started out as an English and music major many years ago. But here I am doing this, and there's lots of room for people to work in the Bitcoin space. If you're obsessed with Bitcoin, you can do graphic design work, you can do business development work, you can work for a Bitcoin company, you can do many different things. Here's the traditional way to generate income. You do work. This is sort of proof of work in our lives. Now, you're welcome to take your capital, to take your savings and put it in an actively managed fund like MSTY, or a passively managed fund if you want to. But I just think you better understand that part of your returns may be coming from the funds holding U.S. Treasuries to generate yield. This is what it says in the MSTY prospectus. And also part of your quote-unquote returns are simply return of capital, which means that the fund management company is returning some money to you that you gave them in the first place. So it's very important to understand MSTY is a very complicated product, and in many ways it is a black box. They do list their holdings, but we don't know how it will perform over various points in time. And there's a huge problem with the covered call strategy in general. It underperforms by a lot when something goes up a lot. So I don't think it makes sense to do any sort of covered call strategy on Bitcoin or on MSTR, both of which we expect to go up a lot over time. Here's the S&P 500 covered call ETF, which is basically covered calls on SPX or SPY. And if we take a look at its multi-year performance, the red line here, this sort of dark red line, is SPY, just the S&P 500, plain vanilla ETF. And then the blue line here is the covered call version of that. The red one, SPY, is up 57% over this period since 2021, while the covered calls are actually down 13.22%. And the fact that MSTR is much more volatile than the S&P 500, this is irrelevant to the analysis. The premiums will still be higher for these call and put options, but again, writing covered calls, it's actually a very basic Wall Street strategy, and it does not guarantee super high returns. And certainly if you do it against assets that are going up a lot, you're going to underperform those assets. For example, in 2009, I did a covered call position, I remember quite well, on some shares of Apple that I owned, that I bought during the great financial crisis. I did it just on a portion of my portfolio position in Apple, not all of it. I made something, I can't remember exactly, but something like 15 or 20% on my money over a very short period of time, because Apple had become very volatile during the GFC. And as we were just talking about a moment ago, implied volatility was elevated. And so the option premiums I was collecting were quite fat. But I ended up giving away my upside on a share adjusted basis. I don't know, this was Apple at $2 a share or something after all the splits it's had. So I basically, by selling these calls, I gave away and capped my upside. I would have done far better just holding on to my shares of Apple for 15 years. And I did hold on to some of it for a multi-year period, but the part that I wrote covered calls on, the shares were called away from me simply because Apple stock went up so much, and obviously went up a lot over the last 10 to 15 years. Of course, you can, after the shares are called away from you, you can buy new shares and you can write covered calls again, but you will end up underperforming in the same way that that this product XYLD underperforms SPY. So Apple was something I expected to go up a lot. So what I did with these covered calls was kind of stupid. I would have done far better just holding on to these shares of Apple for 15 years and perhaps selling off small pieces of it to generate, quote unquote, generate income and pay any necessary living expenses. And this is also, as we mentioned earlier, a more tax advantage way to do things, since long-term capital gains tax rates are usually lower than income tax rates. At least they are in the US for now. BTC is going to go up forever. Bitcoin has no top because fiat has no bottom. MicroStrategy or strategy MSTR will also probably go up for decades, assuming that something doesn't go terribly wrong or happen, or something bad happens to the Bitcoin that's being held by its custodians. Again, that's not to FUD MSTR or criticize Saylor. It's actually quite interesting what he's doing. I think it's the greatest example of financial engineering I've seen in my lifetime. And it's true. You're welcome to own BTC. You're welcome to own MSTR. You just have to understand that every investment comes with trade-offs. And I personally prefer scarce digital commodities that I can hold as a bearer asset in cold storage. And there's only one of those in the world that's worth holding. It's called BTC. It's called Bitcoin. So I would just say you're welcome to invest in whatever you want. You're welcome to call yourself a Bitcoin maxi if you like that label. Again, it's sort of a term of abuse that's been adapted, but you're welcome to do what you want. Just don't fool yourself by buying MSTY unless you really understand how it works and what can go wrong. And it's a bit of a black box because it's actively managed. If I had a choice between holding MSTR and MSTY, I would pick MSTR every single time. Again, given the choice between MSTR and BTC, I would pick BTC every single time. But there are places that it can be very difficult to hold BTC. Maybe MicroStrategy MSTR makes sense for those places. And maybe MSTR does outperform BTC. Again, you're taking on some counterparty risk here. You're holding it in a brokerage account. It's slightly less mobile, etc. These are trade-offs. It's not to criticize one thing over another. I just personally prefer BTC. I try to keep it really simple and then focus on other things in my life. There are other ways to generate a Bitcoin income stream. There's no substitute for working hard and providing value to the world in exchange for goods and services. So go get a side hustle and ask to be paid in Bitcoin, or just get a fiat job, quote unquote, mine fiat during the day, and then use that fiat to pay your living expenses and maybe even to buy more BTC if you can keep your expenses less than your income. That's one time-tested way to generate income. You actually just do some work. I'm going to put a link to the MSTY prospectus so you can take a look at their exposure and their strategies and the risks associated with that. But again, this is something where you're basically selling calls to give away the upside. So it's not something that I am interested in at all. I've seen so many of these Wall Street products come and go over the years, and I've never seen anything like BTC, though. It's a very, very special asset. And so that's where my money is today. And if I need to sell some of it to pay a family medical expense or to help one of my kids start a new business or do something like this, I will just sell the BTC. Maybe I'll borrow some dollars against it, but I probably would just end up selling the BTC if there were a family emergency, if someone really needed my help. Again, this is what money is for. It's for helping people, and it's also for providing for yourself in old age as well. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.